Alarm bells are ringing on Wall Street as fears grow that the latest slide could morph into a full-blown correction. Investor jitters over delayed Fed rate cuts and sky-high AI valuations already intensifying ahead of Nvidia's earnings and key jobs data. Live from Singapore, this is Insight with Haslinda Amin, where we cut through the noise with context that matters and analysis that counts. A global sell-off in stocks extending into a fourth day as investors shift away from riskier assets amid lingering uncertainty over interest rates and tech earnings.
I think in equities today, investors should have maximum 40%. If you're at 40% in stocks and 20% or 25% in bonds, you've got another 35, 40% to allocate. And I've been very, very bullish on gold. The rest, I think I would be in cash because I think valuations are just incredibly high.
Jeff Gundlach says investors should be holding more cash. We'll put that view to some top money managers. Laffer Tengler Investments CEO and CIO Nancy Tengler is just ahead, and later we get insights from VP Bank CIO Felix Brill. Meanwhile, Japanese Prime Minister Sanae Takaichi faces a diplomatic test after angering China on the Taiwan issue. The tensions could weigh on Japan's economy if Beijing decides to turn the screw on critical minerals. And we speak to the co-founder and chairperson of India's Renew Energy about how her firm is helping the country achieve its ambitious climate goals as power demand surges. Asian markets joining a wider global sell-off extending into a fourth day. Concerns around high-tech valuations are rising, especially as traders await chip giant Nvidia's earnings on Wednesday in New York. We've learned that Peter Thiel's hedge fund sold its stake in Nvidia last quarter, adding to negative sentiment after SoftBank made its own exit from the AI bellwether. Double Line Capital founder Jeffrey Gundlach is the latest on Wall Street, ringing alarm bells over the U.S. stock market.
The health of the equity market in the United States it's among the least healthy in my entire career in terms of the PE ratio, the CAPE ratio, all the classic valuation metrics are off the charts.
Markets also waiting for the delayed September U.S. jobs report due on Thursday for further clues on the Fed's policy outlook. Fed Governor Christopher Waller calling for a rate cut given weakness in the jobs market.
This reading of the data leads me at this moment to support a cut in the FOMC's policy rate at our next meeting on December 9 and 10 as a matter of risk management.
Meantime, Japanese media reports say senior diplomats from China and Japan plan to meet in Beijing today as the dispute over the Japanese Prime Minister's comments on Taiwan continues to simmer.
Regardless of which party or individual governs Japan, it must adhere to and honor the Japanese government's commitment on the Taiwan question. We urge Japan to act responsibly toward history and bilateral relations, stop crossing lines and playing with fire, retract its erroneous words and actions, and genuinely implement its commitments to China through concrete actions.
Let's bring in our China correspondent, Min Lo. And Min, what can we make of today's meeting of diplomats? Is it an attempt to dial down the temperature?
Well, Japan obviously trying to play down the fallout from this incident. They are sending the diplomats to China, and they'll be meeting later this afternoon. And we are also seeing the Japanese embassy issuing an advisory for its citizens in China, warning them to be careful when they're outdoors, to avoid large gatherings when they're outside, and to take special care if they have children. It seems like there is some fear brewing about maybe potential breakout of protests in China. But yes, China has repeatedly, and yesterday they repeated again, this demand for Japan to retract the statements on Taiwan. But Takaichi so far hasn't done that, and China is seeing this as a strategic shift in Japan's stance in Taiwan. We had seen very sharp rhetoric from Beijing, Chinese state media as well. So interesting to see how this meeting later this afternoon pans out.
Min, how much impact are we seeing from Beijing's travel advisory? Are people actually cancelling their trips?
Yeah, we are seeing a pretty mixed response so far. According to sources and what they're telling us, we are seeing not many people canceling their trips at the moment. But if you look on Chinese social media, on Weibo, for instance, we are seeing very nationalistic comments. Here you can see someone saying, I'm never going to Japan in this lifetime, even if it's a free trip. Others are saying that Japan really hasn't repented from their crimes during the war, and we should really put our flags and send our troops to the Senkaku Islands, the disputed islands, to teach them a lesson. And still others are saying, there is, no room for negotiation when it comes to China's sovereignty. But if you look at Xiaohongshu, that's where you see a lot more younger audience gathered there. They are a little bit more positive. Some of them are saying politics is politics, life is life. They're still going to go because there's already some sunk costs, right? You already paid for some attraction tickets. There are no refunds. So it doesn't really matter as long as they're cool-headed about where they really stand on this matter.
Bloomberg China correspondent Min Lo, thank you so much for that. Now, plenty more ahead. Keep it here with us. This is Bloomberg.
In recent years, the garbage lending has not gone to the public markets. The garbage lending has gone to these private markets. And private credit has been very popular and is now increasingly been over-allocated to by large asset pools. The next big crisis in the financial markets is going to be private credit. It has the same trappings as subprime mortgage repackaging had back in 2006. Now, it took a couple of years for it to totally unravel. So this stuff doesn't happen in a week or a year even. But I'm very negative on that.
That was Double Line Capital founder Jeffrey Gundlach with his concerns on the outlook for private credit. Now, KKR's co-head of credit and market says he disagrees with Gundlach's views on private credit. Christopher Sheldon tells us exclusively that the key to managing risk is keeping a close watch on valuations.
We're just not seeing that elevated concern. However, we are seeing slowing in the economy, and we are seeing more dispersion in results. We see that in the public markets, we see it in the private credit markets, but we're not seeing that level of concern that Jeffrey mentioned.
It seems like we haven't really seen a million cockroaches, right? You've seen a couple of really idiosyncratic issues, and it's hard to argue otherwise. The problem isn't that there are occasional bankruptcies here and there. It's that BlackRock marked this debt at 100% and then 2 weeks later at 0, even though they knew from months beforehand that there had been negotiations about a revamp here. It's the marks that are the real problem in these issues. And do you think that the industry needs to look inward and figure out a better way of doing that?
Look, I think we use a third-party valuation to evaluate all our illiquid assets. And I think where you're seeing dispersion in the valuations are when assets underperform. And so I think it's really just about a policy to make sure that you're working closely with those independent valuation providers to make sure you're giving the real up-to-date information of what's going on in an individual credit. How others are doing it and the velocity of the moves is depending on each situation. And you are seeing, to your point, very idiosyncratic situations that sometimes move extremely quickly in terms of if they're hitting a liquidity wall, to where maybe there is a little bit more aggressive in quickness of moving that mark.
Chris, it's interesting you talk about the divergence, because maybe the kind of dirty little not so secret of this industry is that private credit returns don't look that different from player to player unless you do something that really gets messed up. So in a world where you also have more money coming into the asset class, where you have rates coming down, how difficult is it to find alpha right now in private credit?
Yeah, and private credit is defined, depending who you talk to, it's defined in many different ways. And you're right, there hasn't been a lot of dispersion in corporate direct lending returns manager to manager, although I expect more and more dispersion to happen. And so what we're really doing across our corporate direct lending book is running very diversified portfolios, keeping it very high quality at the upper end of the middle market. And I think that's where you should be playing, is not reaching for that incremental yield, incremental few basis points, which often leads to risk. I think where dispersion in returns will happen is when you make more concentrated bets or you're reaching for incremental risk.
KKR co-head of credit and markets, Christopher Sheldon, speaking to our colleagues Matt Miller and Danny Berger. Let's get perspective from Nancy Tengler, CEO and CIO at Laffer Tengler Investments. Nancy, you got to wonder, how did we get here? We're questioning the private market. We're talking about doom, gloom, bubbles bursting. Where do you weigh on all of this?
Well, Haslinda, thanks so much for having me. I was managing money during the real bubble. And I would have to respectfully disagree with Jeffrey Gundlach. We had valuations that were significantly higher than the current environment. Plus, we were in a period from 96 to 2000 where earnings were actually contracting, but valuations were accelerating. We're now in an environment where the earnings growth for these large growth companies is averaging around 20%. And the valuations are healthy. But if you look at the equally weighted S&P, it's about 17 times next year's earnings with a 10-year at 4%. So I think we have to step back and say, what are the issues? And the issues that drive equities are earnings growth. And we think earnings growth will accelerate next year, in some part thanks to the One Big Beautiful Bill Act, which is accelerating depreciation and CapEx spending.
Not everyone is convinced, obviously. Peter Thiel just sold off his holdings in Nvidia. We have Michael Burry waging, a bearish bet on Nvidia as well. You hold Nvidia. I mean, how are you making sense of that divergence, huge divergence in views?
Well, I would say, Haslinda, that Peter Thiel's decision was a portfolio management decision. And we do sell our winners from time to time. But if you look at the valuation, and I can't speak to Michael Burry, he shut down his fund. I don't really know what the motivation is there. But if you look at NVIDIA's earnings growth, it's going to be for fiscal year 27, which starts in February of next year. Expected to be about 50% by Wall Street. And it's trading at 26 times those earnings. I would not call that a lofty valuation. Cisco is trading at 100 times peak earnings going out of the 1990s. But NVIDIA has a healthy pipeline. We know that that Blackwell is oversubscribed. Rubin is about to be launched. This is all without China. So I think you have to look at NVIDIA's valuation and say, I'm paying a PEG ratio, price earnings to growth, at 0.5%. Tesla's trading at 5 times. So I wouldn't use NVIDIA. I wouldn't say NVIDIA is overvalued. I think the question becomes, how sustainable is the infrastructure build out? We think we have years to go. Originally, it was thought that it would be $1 trillion. Now we're looking at $3 to $5 trillion. By 2030. And we're seeing the use cases multiply across sectors because we sit on all the company earnings calls.
So if you think that it is sustainable, you should be buying the dip, correct?
Yep, we are. We are, yes.
And other
And we
people
did
should
in
too. It's not
April.
too late to get in if you're not already in, Nancy.
No, that's true. We were buying in April, so we were able to pick off names like Tesla at $240 a share, Nvidia at 100, Palantir at 80 or 90. I can't remember exactly. And so once again, we'll get a chance, and we will be adding to the high quality names. You know, Google is a name that we own across all of our strategies. We bought it a while ago. It was when people thought that AI would destroy the search business. It's enhanced the search business. We own Amazon as well in our 12 best ideas portfolio, a company that is expanding margins and still growing their ginormous cloud business at 20%. So there are a lot of things to like. You just have to get past the rhetoric. I just wrote a piece called The Bubble in the Bubble Talk, and this is what you get in various periods during a bull market. So we stay committed until we get evidence to the contrary. And we don't have any, Haslinda, at this point.
You talk about it being a bull market. Are we in a new bull market? There's a sense from the likes of Morgan Stanley saying that we are, and they're expecting the S&P to have an upside of about 16% from here.
Yeah, so we don't do S&P targets, but I would say we're in the bull market we started in 2022. And that bull market is up about 100%. But remember, in the 90s, we had a bull market that ran about 400%. It was a productivity-driven environment. That is what we have now. This will unfortunately cost some jobs, but will also make companies more productive, employees more productive. And we're still at an unemployment rate in the US of about 4%, at least as far as we know, based on the data that we have not received over the last couple of months. So I think you have to be, I mean, whether it's a new bull market or an old one, it can continue for quite some time. And remember, consumers in the U.S. are going to get $150 billion or up to $200 billion in increased tax refunds. They're going to spend that. So in addition to loving technology, we've been adding to consumer discretionary names because we think they will have a run in the coming months.
How much is this rally? How much is this run at risk of a Fed that does not cut in December?
Yeah, so the Fed, I've been pretty vocal about this. I think they've been wrong at every turning point. If you just look at where we are from a retracement standpoint, so the Fed raised 550 basis points, they've cut 150. That is about a 28% retracement. Switzerland is at a 70% retracement. So we're way behind the rest of the world. I can make an argument either way that we cut or don't cut. In the 90s, we had a Fed funds rate of about 5%, inflation of about 3%, but we also had productivity-driven growth. So I think the mid-cap names, a lot of the speculative names like the quantum names are waiting for another Fed cut. I expect we'll get one. I just don't know if we'll get one in December or January.
Nancy, whether the Fed cuts or not, I think what's really key here is that the Fed is divided, and whatever it does, I mean, people will question or not whether it is the right move, right? It does not instill confidence. Might that play out in the market?
Yes, you're absolutely right, Haslinda. I think the market has lost. I mean, if you just look at the first 100 basis points that the Fed raised, the 10-year was at 3.7%, and it rose to 4.5% after the cut of 100 basis points. So the market is skeptical of this Federal Reserve, the data-dependent Federal Reserve that has not been ahead of the trends. And so I think that it will become less and less relevant as earnings growth continues to be reported as we finish out this season and then the next. And then in addition to that, once we start getting data again, I think that will give investors a clearer picture. But the Atlanta Fed GDP now numbers at 4.1% for Q3. We will see a slowdown in Q4, but inflation seems to be pretty stagnant, and the job market is a little wobbly. So I think the Fed probably should cut for sentiment purposes, and also because investors have been devoid of data. and that makes them nervous. And I think that's part of what's driving this sell-off.
We're in, I guess, unusual circumstances, and we're seeing pretty unusual moves in the gold. You've been a gold bull for a very long time. How are you reading, the current movements in the bullion market?
Well, it's complicated, but also quite simple. I think when people are uncomfortable and nervous about global growth, they tend to turn towards, real assets. And gold has been a place to be. Central banks are buying it, so that's driving up the price. And we think it will continue, but the pace will probably moderate somewhat. You've also seen silver have a huge move, and that seems reasonable to me. And then we own many of the other commodities, copper, we own platinum. So I think there are ways, and Cameco, which trades in uranium. So I think there are plenty of places where investors can sit back and hang on to the real assets while they let their risk assets run.
Is it problematic to think that gold is a risk-free, trade at this point in time?
Yeah, it is problematic. It is not risk-free. It's a supply and demand trade. At some point, the demand will shift. But right now, you have central banks really propping up the demand. Once that changes, then I don't know that we're going to see a major sell-off, but we will see a flattening of the curve.
And when might that happen, you think?
I don't know, Haslinda. I mean, a lot of it just depends on, global policy, but also policy in the U.S., tariff policy, relations with China between the U.S., between China and Japan. So I think you'll continue to see people or countries, sovereignties, hover and gather gold. But I don't think we're going to see it at the pace we've seen it. And that's what, at the margin, that's what drives price performance.
And in your view, if you take a look at the next 12 to 24 months, what are the more compelling investment themes that you're looking out for and investing in?
Yeah, so our theme has been and continues to be old economy companies, Haslinda, that are embracing the new technologies. So Walmart has been the poster child, and as you know, they report this week. But they've embraced every technology, and it's gone straight to the bottom line, improved same-store comps and also margins. So we're going to continue to watch that. But another name in the old economy is Raytheon, or RTX, which is utilizing AI to improve supply chain and missile production. But then we like the picks and shovels. And so if you look across sectors, you can find AI beneficiaries in financials, pharma, industrials, and those are the names that we've been focused on. In our 12 best ideas portfolio, we own in the industrial space Quanta and Uber. In technology, we own Palo Alto Networks, ServiceNow, Amazon, Microsoft. So there are a lot of ways to play this, but you don't have to own the Mag 7 alone. And then we do own Tesla. Yeah.
Nancy, always great to have you with us. Nancy Tengler, CEO and CIO at Laffer Tengler Investments. Now, still ahead this hour, we get the outlook for Indian markets as New Delhi says it's close to concluding tariff talks with the U.S. Equirus Family Office CIO Chanchal Agarwal will be joining us next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside, and Bitcoins continue to be under pressure, breaching below that 90,000 level for the first time in 7 months. It has erased all its gains for the year, dragging the broader risk complex with it. Bitcoin, by the way, roughly down about 16-17% this month alone, 2% on the year. It was once the best performing major asset class of 2025. Again, Bitcoin dropping below that 90,000 level for the first time in 7 months. Some say that it could get to 80,000 level. Brace for Bitcoin and other cryptocurrencies. Now, here's a quick look at where markets stand as mainland Chinese markets head for that lunch break with the CSI 300 index in negative territory, along with most of the Asian benchmarks. The Hang Seng also lower as we speak. Though we have Morgan Stanley saying that Chinese equities may enter a phase of consolidation next year amid an uncertain outlook for corporate earnings and high valuations. We're also keeping an eye on Japanese markets as they come back from lunch. SoftBank leading declines today amid broader risk of sentiment around tech. The company revealed last week it had cashed out of its stake in Nvidia in October, adding to concerns among investors over lofty tech valuations. Nikkei 225 currently down by more than 2%. The topics also lower as we speak. SoftBank, by the way, down about 5.5%. We're also watching the start of trading for the Indian rupee. Indian markets are focused today after Commerce Secretary Rajat Agarwal said New Delhi was close to finalizing the first part of a trade deal with the U.S. Of course, it is about 15 minutes to the start of India's trading day. It is trying to inch upwards. In terms of the Indian rupee, it is flat at 88.67 as we speak. Now let's bring in India trade and economy reporter Shruti Srivastava. Shruti, what do we know about that trade deal?
So yesterday, Commerce Secretary Rajesh Agarwal, who is also the chief negotiator for India-US trade deal, he commented that India and US are very close to concluding the first phase of a multi-tranche deal. Now, India and US decided that they will structure the deal in multiple tranches. The first tranche, the Commerce Secretary said the first tranche would address the reciprocal tariffs and all other tariffs which the US has imposed on India. The US imposed 50% tariff on India in August. And since then, India has tried to appease Trump administration by, they have scaled back their purchase of Russian oil. Yesterday, Indian oil minister said that the country has signed a first long-term deal with the U.S. to import liquefied petroleum gas. So these are some of the steps that India has taken to conclude the deal as soon as possible. And soon after these comments, U.S. National Economic Advisor, he too made a comment that India and the U.S. are very close to signing a deal. So I think it's a matter of time. Both the sides have signaled optimism that there should be a deal soon.
We understand that the first phase of this trade deal will include tariffs. As it stands now, India settled with 50%. Any indication how low that might go?
Haslinda Amin, can you repeat the question, please?
Yeah, we're just wondering how low the tariffs might go from the current 50%. Any indication?
So far, both the sides have not indicated what the new level of tariffs for India would be. However, there have been media reports that, India is hoping for a tariff as low as between 15 to 20%. So if at all the tariff is, around 20%, that would at least bring India close to its regional rivals like Vietnam, with whom right now India is basically losing its competitiveness. At 20%, Indian officials maintain that Indian exports would become, at least, they would be able to balance their interest and become competitive when it comes to their regional peers. At 50%, Indian exports have lost all their competitiveness, especially the labor-intensive sectors like, textiles, gems and jewelry. They have been hit the hardest. And remember, US is India's biggest market. More than 50% of Indian exports to the American market has been impacted by 50% tariff. So anything around 15 to 20% will certainly help Indian exporters.
Shruti, thank you so much for that. Bloomberg India Trade and Economy reporter Shruti Srivastava. Let's get more with Chanchal Agarwal, Chief Investment Officer at Equirus Family Office. Chanchal, your thoughts? We know that those tariffs roiled the Indian markets. Will that reverse sentiment?
Oh, I think that's the question that all of us have been pondering and waiting to hear what the magical number is. I think more than the tariffs, I have all my years to understand what are the trade deals that India and US has been negotiating. Separately, I think I'll allude to what Ms. Srivastava just said that media reports have been pointing around between 15 to 25. Anything between this is a number that markets have already settled in for. So I'm not expecting too much, cheer in the market when this number gets announced. Of course, any surprises on the negative side, could have only a short-term impact. And second part of this, we also have to understand the tariff is on the US consumers and not really Indians. Of course, it does affect our export competitiveness, but I'm not expecting a number closer to 50 over here.
Well, if you say that everything's been priced in already, yet we see the rupee lackluster, still a very weakened currency. Why is that? What would it take to reverse some of that sentiment?
Of course, a large part of it has been derived by the whole FII outflows that the Indian markets have been seeing since the past, some months, years. If I have to believe the number, about 2 lakh crore worth of FII outflows have just happened in the calendar year 25. To my mind, I think that's the highest that we have seen. And technically, if it was the old India, if it was the India of 2008 or 2013, by now our currency would have crashed, right? So in fact, to the contrary, I'm not really negatively surprised on the way currency has behaved on this point. The positive triggers around here is, of course, the earnings growth. So if you see the last quarter ex financials, we reported about a 12-13% of earnings growth, beating what the street was expecting. If I have to just normalize the nominal earning growth for the year, 14-15% seems like a good number. So I'm a little positive on the way both monetary and fiscal policy has been working in getting the earnings growth back to the number, and I'm not negatively surprised on the way currency has behaved.
How about in terms of foreign funds, which have continued to make an exit from the Indian market? What will it take to get them back?
You will have to see that we're lowest on the monetary policy. So just alluding back to what I was discussing in the last paragraph, this is the lowest on yield. So you have the reserve banker, which is pushing guns. You have the government, which is prioritizing sector. And when I say sectors, they are very pro-manufacturing. There are a lot of PLI schemes that has been announced. You have tax holidays that have come up on sector. And so technically the government is firing all guns to get the whole manufacturing back to India, right? So this is the rarest of times where you have both monetary and fiscal policy working together to get the growth back. Also, this works with a lag, right? So your earnings cut, started a couple of quarters ago. Typically, the way it happens is the transmission only happens with a lag of 12 to 18 months. Which is what we've reached, right? So you have the benefit of rate cuts coming in. You have the banks which are now ready to lend to sectors transactions, which earlier were not allowed by a reserve banker, right? So there is a credit growth, that could happen over there. So I'm positive on that front and keeping all the fingers crossed.
And yet the Sensex is due for an underperformance for the first time since 2022. How would you be positioning? What would you be buying so that you can ride that, overperformance perhaps that's due for the Indian market?
So I think the Sensex could have been worse. Like think of it, look at the amount of money that has gone across our markets, right? In the last 1 year, ideally the Sensex should have been in deep red. The only thing that it's actually flat or slightly negative is largely because of the way domestic economy and domestic investor money has supported the market, right? That's a larger positive that I actually look at. Think of it, I'm getting a Sensex which is 1 year dated from now, but with the added additional earnings growth of 10 to 12%. From an investment perspective, I'll want to put some cash for deployment into equity right now. With some sort of dynamic staggering, assuming there are some macro bearishness in the market, I'll deploy at those levels. But if the question is, am I deploying at this point? Definitely yes.
But where exactly? Which sectors are attractive, looking cheap in terms of valuations?
Okay, so we track managers, but not the sectors. But just to give you a very broad overview, I am actually very strongly looking at consumption, right? So typically, whenever an economy moves, the first growth sector, and in a cycle where you're lowest on rates, right? Typically, the way your general economics suggests is whenever the interest rates are low, the spending propensity increases versus what you would save. largely, right? So all eyes on how the consumption sector is behaving. Is rural consumption coming back into system? That would be the first trigger, and then it will flow down to your banks, to your capital goods, and so on and so forth. So I have all my eyes on how consumption is behaving over the next couple of quarters.
And of course, we've had that Bihar election where Prime Minister Modi had a victory for his party. Will that translate to perhaps more populist spending and hence play into your consumption story?
That's true, right? So typically, closer to elections, you see the government's spending around the socialist sectors coming increasingly high. In fact, we were just looking at a chart. This is the highest ever state government spending on socialist schemes. If you have to plot it on a trajectory, we are at the highest possible right now, right? So there's just a lot of money that has been pushed into the system. Either it's via direct lending to challenged or to the sectors, or is it via growth that has been pushed via the banks, etc. So I think there's just a lot of money that's getting pushed into the system. In fact, if you just go back and see, this week RBI also pushed down some liquidity into the market, which pulled the 10-year below. If this also does not get spending back to the system, then I'm really worried. To kind of summarize the whole context for you, this should definitely spur up consumption. If not, there's something really wrong, and both of us need to go back and reanalyze the thoughts.
Chanchal, a lot of people talk about how India is missing out on the AI rally, but there is a tech rally going on in the Indian market. We saw, of course, the very successful debuts of the likes of Grow and Pine Labs. What do you make of that momentum? Can that persist?
So I think India is different from the way your US or China would behave, where a large part of your deep tech or AI rally is in the listed or higher market cap space. In India, if you just go a notch below and look at what the private market is doing, private equity, startups, etc., there are a lot of interesting ideas that have been grooming up. So India, unfortunately, is bottoms up, where you have the private sector which is taking the initiative. And over the course of this decade, we'll see a lot of these companies coming on the main board and tapping the success. Call it since you mentioned Lenskart, look at the numbers that Lenskart, got listed at, or even if it is Grow, or even if it is something like a Deserve, which got valued very richly. I think tech is being appreciated, but there are a lot of ideas, industries beneath in the startup and private equity space, and I think that is the decade where these companies will have a manifold growth and come to the main wars.
But are these companies, are these valuations supported because of the liquidity in the market, because the retail investors are so keen to put their money to work? They may not necessarily bring the value that people are expecting, but it is the money that's sloshing around that's propping them up.
Where else would you have such a big retail market with a demographic advantage, right? What we are playing on is India has the largest retail market. So if you have to just put it in a pyramid, your top 1% is something that that's been catered to and looked upon. Your bottom lowest thing, which is the mass market for India, is still where I will see consumption, and these are the people who are probably daily wage earners, etc. Right? The middle segment is what is really increasing for India in size, right? So if anything, any product, be it deep AI or finance or anything that caters to that middle segment is going to get valuation, because nowhere else you will have such a high retail segment with a demographic advantage, right? So that's the best combination, and that's exactly what is getting priced in the valuation. Not really the whole retail rally and plush liquidity that we would have.
It is glass half full kind of perspective, Chanchal. Foreign investors are taking their money out from the stock market, but they're putting money into the bond market. Do you see that momentum picking up?
I mean, I'm also kind of scratching my head around it and trying to see that why would somebody want to play a duration right now, right? We are a 6.5 on the 10-year. With probably a more rate cut, but I think that's off cards right now, right? So this is the worst time that anybody would want to play duration in India, right? I'll definitely be on the shorter end of the curve. So around maximum 4 to 5 year on the curve is what I'm looking at. I will in fact want to take leverage at this point and have a carry that is building up in the equity markets around that, right? And we could have, we could debate around why private sector capex is not picking up, manufacturing is a challenge, and so on and so forth. But if I have to take an asset allocation calls, I will still want to be on the equity side. From an FII perspective, I think 6.5 minus the currency depreciation. So if you're not seeing the US dollar to move sideways, I think that's a good bet that they can take. Even if it's a 6 post everything, that's still better for risk adjusted return. So I think FIIs have that in mind.
Chanchal, I just want to mark the opening of the Indian market. The benchmarks are currently in negative territory pretty much across all benchmarks. The Sensex down 0.2%. Nifty Bank Index also lower. To your point earlier, it does seem like, investors have already priced in that trade deal between the US and India, and it's certainly not boosting the market in any way.
Yes, I think that's exactly where I was. Everything is largely priced in. We're just waiting for if there is a negative surprise. Otherwise, it's more or less a non-event for us.
And before we let you go, Chanchal, in terms of the Indian rupee, because it's trading, hovering close to record lows, how will it end the year? How will it do in 2026?
Okay, difficult one. I'll be okay if it shoves another 2% over here. That still makes our exports better, right? And oil has been more or less balanced, right? So it's around the $60-65 on oil, which is the major import item that we have. A small currency depreciation does not really hurt too much to our export balances, right? So if oil is behaving the way it is, currency depreciation over the next couple of months is not something that we are tapering to. Of course, 26 will have to be a little more stable on oil more than currency. If you see both currency and oil giving up at the same time, then we dial back risk again. But a little currency depreciation is always good from the export perspective, and I think we are in desperate need of getting our exports back to normalcy. So of course, the flip side to it is, your borrowings increase, etc. But I'm not too worried on how currency behaves. A 2 to 3% over here over the next couple of months is fairly fine.
What is the one conviction call for you in terms of an investment that you must make in the next 12 to 24 months?
Okay. I will actually go high on small caps India. Giving a very specific calls, if I have to go high on equity, which sector do I like? This is a lot of froth that was cleaned up, that was there on the small cap space. I think a lot of cleanup has happened in the last 1 year. I would like to take active allocation calls on the small to mid cap sector of the market. Slightly negative on long duration. I'll be on the shorter end of the curve, and I think I maintained this from the last call that I had with you. Gold and silver was more of a currency trading call for us, more than a long-term asset allocation, and I think that's fairly done. So I'm not increasing my bets over there.
Chanchal, always a pleasure to have you on the show. Chanchal Agarwal, Chief Investment Officer at Equirus Family Office. Coming up, the maker of the most watched viral video of all time, surging on its trading debut in Seoul. More next on what to expect from the company behind Baby Shark. Keep it here with us. This is Bloomberg. Familiar jingle, the studio behind YouTube's most watched video. We're talking about 16 billion views is Pinkfong, which made its trading debut in Seoul today. Let's do a check on how the stock is trading. Well, up 21% as we speak. Let's bring in Asia Equities reporter Sangmi Cha. Sangmi, there seems to be a lot of exuberance here. The question really is whether it is sustainable. I mean, it is cute, but is it sustainable?
Yeah, I mean, that's really the million-dollar question, really. We have to understand that it reflects back to its peer SAMG Entertainment, which also creates some of these animated cartoons. And its actually stock has tripled this year since its IPO. And this is just going through this momentum for all these children's children's videos, and these has been like a worldwide effect. It's not just in Korea, but we've been seeing similar trends over in Hong Kong, in Pop Mart and Sanrio, the Hello Kitty maker as well. Now, whether it is sustainable, this trend we have to keep watch. But it is true that the stock is undervalued at IPO price. It's traded at about 25 times 2025 earnings, whereas its peers are traded at about 40 times.
It has 280 million subscribers. I suppose to sustain that as well, you need new content. What do we know about the strategy of the company?
That's correct. It's really been 600 times oversubscription. It was so popular, despite the fact that the IPO raised just $53 million. So everybody was going after this blockbuster IPO because of the popularity of this jingle that we just heard. And the CEO says that the key is to diversify, to have more of its IPs, so just more of the characters. And there is this other franchise called Bebefin, which has actually it surpassed the revenue from the contents for those of the Baby Shark. So we can already see that the company has been expanding into different characters and franchises, and they're seeking to do that more so. And we'll have to see if that trend continues for the company.
Sangmi, thank you so much for that. Bloomberg Asia Equities reporter Sangmi Cha there. In terms of the Asian benchmarks under pressure as we await numbers from Nvidia that could just move the sentiment in the market. We have the MSCI Asia Pac Index down about 2% right now. Of course, we're also keeping an eye on the U.S. jobs report. Perhaps that could be an indication of what the Fed might do in December. Still ahead, an insight. VP Bank's CIO tells us why he expects more noise than direction for markets over the rest of this year. Felix Brill will be joining us in just a moment. And later, Indian wind and solar power generator Renew joins us to discuss the outlook for green energy development after COP30. Keep it here with us. This is Bloomberg.
In recent years, the garbage lending has not gone to the public markets. The garbage lending has gone to these private markets. And private credit has been very popular and is now increasingly been over-allocated to by large asset pools. The next big crisis in the financial markets is going to be private credit. It has the same trappings as subprime mortgage repackaging had back in 2006. Now, it took a couple of years for it to totally unravel. So this stuff doesn't happen in a week or a year even. But I'm very negative on that.
And that was Double Line Capital founder Jeffrey Gundlach speaking to Bloomberg's Odd Lots podcast about his concerns on the outlook for private credit. Now, KKR's co-head of credit and market says the firm, one of the biggest players in private equity, isn't seeing any elevated concerns. However, he notes signs of a slowing economy.
Our revenues are up 9%. Our EBITDA is up 8%. Our interest coverages are healthy over 2 times. Our average LTVs are sort of sub 60%. So we're just not seeing that elevated concern. However, we are seeing slowing in the economy, and we are seeing more dispersion in results. We see that in the public markets, we see it in the private credit markets.
Let's get perspective from Felix Brill, CIO at Liechtenstein-based lender VP Bank. Good to have you with us. So we heard from KKR saying that expectations are that it's a slowing economy. If it's a slowing economy, that could have implications on the private credit space, no?
Yeah, definitely, it would have. And actually, we see signs the economy is slowing, but we don't know exactly at the moment the amount of the slowing because we didn't get any data in recent weeks because of the shutdown.
Is Gunluck wrong in warning that there is trouble brewing in the credit space?
No, I don't think he's wrong, but the matter is what is the timing on that? So if you invest in private credit, you have to make sure to diversify, and because the law of the big numbers, they sound good if you do back testing and whatever, but if you're a private investor, have just exposure to some companies in the private credit space, if just one of those goes bust, you are hit, and that hurts.
And that is a concern because we're seeing signs already. This is a very illiquid and not so transparent market, correct? And therefore, if the problem were to arise, it could unravel really quickly.
Absolutely. And we've seen that time and time again in the past. For quite some time, it's fine to be invested if the sun is shining. It's nice to go out, right? But if the weather turns bad, if it turns sour, then sometimes the exit is very, very narrow and
so
it's difficult.
You would continue with the sign of caution. You would continue with that tone in the private credit space.
Yes, definitely. Actually, on most of our clients, we don't do a lot of private credit. It's not part of our liquid investment strategies. There we focus really on investments where you have more transparency, where you have also more liquidity, so that you can change if things deteriorate.
And the space where there is plenty of liquidity is actually the equity space. But even then, we have fears about that AI bubble bursting. Nvidia is one that everybody's watching. We've heard the likes of Peter Thiel taking money off the table completely. We have the likes of Michael Burry saying, you know what, I'm waging against it. What's your own take on where this AI bubble is going?
It's going somewhere, definitely, and has been going up.
Up or down? Where is it headed? Is it bursting anytime soon?
Honestly, I don't know. And I don't think the biggest risk right now is being invested in AI. Actually, you have to be invested in AI. A bigger risk I see not being invested at all, or only being invested in AI. So from that perspective, it makes sense to, and it's very important, to manage your exposure, to manage liquidity, and sometimes also take profit and reallocate it to somewhere else in the AI space. And we've seen that with SoftBank and Peter Thiel.
So getting exposure in AI doesn't necessarily mean investing in Nvidia, obviously.
Yeah, there's more out there, luckily, than just one company. Of course, it's a very big company. Like if you just look at the market cap, almost $5 trillion US. It's 5 times Swiss GDP. So that's a lot.
So where would you be looking for exposure for AI?
Actually, quite interesting, maybe for the next wave or different pockets, somewhere where it's more AI-enabled or tech-enabled. You can see that also in healthcare. Longevity is a big topic, personalized fitness, and you need all those trackers and stuff like that for that. So there is room for that, or on the defense spending side, also energy, the power grid comes to its limit, and you need a lot of investment spending there. So that is something to look for and to diversify also on kind of the next levels of AI.
Of course, increasingly, we're seeing China coming up with AI plays. They've managed to, it's mainly open source. It's done cheaper than, the counterparts in the US. Would China be a market you look to for AI investment?
Yeah, absolutely. China is really emerging as a global AI competitor, and they take a bit of a different path to it. And I think it's looking like a very promising path. It's more like open source, and for that reason, it might be easier for companies than using AI for their business cases to get profitable sooner. Like that is a big challenge, I would say, in the US right now. Very much focus on the hyperscalers. It's very capex rich, and it takes time to make those business cases profitable. And I think that is the big challenge right now. Probably adoption will happen, but it might take longer than the headlines suggest right now.
How might your strategy be in China, bearing in mind that the U.S. and China are still in negotiations when it comes to trade and export controls? Tech is an area where the two sides are looking really closely.
Yeah, actually, we turned more positive on China recently. Within the emerging market equity allocation, we went overweight for various reasons. We see a bit of a comeback this year. We see positive momentum in the equity market, which can carry on and support the market development. But on top of that, we see valuations. Of course, they have now gone up as well, but they're not as stretched as if you look, for instance, to South Korea or to Taiwan. And on top of that, we see three additional reasons. One I mentioned already on the AI space. It's emerging as a global competitor. But on top of that, we see also that it is less US dependent as it used to be. Of course, we have the tariff risks, but so far China managed to really do very well in this year. And that comes down to the third reason, which is its strong strategic position in rare earth.
Yet the economy is still struggling. How are you factoring that risk into your investments?
I would differentiate between kind of the structural view, the long-term view. The Chinese economy is going to grow less and less over the years because of demographics and over-investment spending in the past. So the Chinese economy will grow every year a bit less than it used to be. But cyclically, that doesn't mean that you can see periods where you see a recovery, also by additional stimulus. If you look at the policy statements recently, they are more supportive on that, and we think that can also be a support going forward.
Given your view on China, would that be a positive for the rest of Asia as well? Could China, lift the rest of the Asian market?
It could, definitely. We see more and more regional trade, right? Also here, that's a reflection of the less US dependency. And for that reason, then other countries will also benefit if China is doing better.
Felix, when you take a look at what your clients are doing and money flows, do you see money flowing from the US to Asia necessarily?
Not yet in a substantial amount, I would say.
Why do you think? People have been talking about, that rotation from the US to Asia.
I mean, probably look at today's headlines, maybe one of the few exceptions, but over this year, the US is just dominating. Trump is dominating. And that, and like performance-wise, with AI, really, and Nvidia, that has been dominating the news and also the perception where you have to be. But at the same time, the flip side is we see that for many of our clients that are not US dollar-based, you see the flip side because the dollar has been weakening so much this year. So it makes sense not only to be exposed to the US, that we argue for that, but also diversify across different regions, across different currencies. And the easiest way to do that is adding the Swiss franc to a portfolio. It's the easiest way. It's almost like cheating.
What are the biggest opportunities in Europe right now?
Within Europe, actually, we would say Spain the economy is doing really well. Actually, it's a bit of a change. If you look back 10 years ago with the Euro crisis, like the big countries like Germany being the powerhouse of Europe. Now that shifted really to Portugal, to Spain because of tourism. That is still post-COVID, 5 years later, is still a very strong driving force, and we see even growth increase. So there's now a game shift a bit of the south of Europe doing from an economic point of view much better than the north, and Germany seems to struggle because also of some structural challenges.
And France is struggling as well. You got to imagine that at some point France could weigh on the whole region.
Do you really want to talk about France?
Might France weigh on the rest of the Eurozone?
I mean, we have seen now, it's really a big change, tectonic change even, that France, as of recently, had to pay more for its debt than Italy. That's never been the case in recent history. So I don't know if it is telling more about France or Italy, but it's probably definitely not a good sign for France.
We're inching ever closely to the end of the year. What are the key themes do you think will play out in 2026?
For 2026, I think it's the slowing of the US economy. How fast will it be? And within that, then what the Fed is going to do. How much room to maneuver does the Fed really have? Because we still see inflation at elevated levels. We still see impacts from the tariff side coming into inflation. So the room to maneuver might be a bit more limited, which might, at least in a transition period, a bit of a challenge for equity markets.
Do you see the Fed cutting in December?
At the moment, it seems a bit like tossing a coin because honestly, they're also probably waiting for the data this week. We are going to see the job markets report. It's ancient history almost. It's October data, but still, we didn't get any data in the last couple of weeks. So it's very important now, the new data releases, also in the inflation report, in order then to assess what the Fed is going to do. It's probably a very, very close call.
There is room for the Fed to be making a big mistake because it's already a divided Fed. Fed officials are pretty much disagreeing, pretty much down the line. I'm just wondering how you weigh that and how much confidence the Fed can give to the investment community.
Yeah. It's going to be a bumpy ride, I would expect, because also you see the attempt to influence politically the Fed, like how the FOMC is who's in the FOMC meeting. So that is going to be a challenge. So what we take out of it, we don't try basically to predict the next headline or the exact move of the Fed. We try to prepare for different potential outcomes. Because honestly, we never ever usually have a 100% guarantee what's going to happen. But you have to be prepared. You have to, by investing, you have to avoid the big mistakes, the unforced errors, as if you talk about kind of like in tennis. And that is how we deal with this level of uncertainty we're seeing right now.
If the expectation is for the U.S. to slow down in 2026, how are you preparing for that? How are you positioning for that? How are you countering that slowdown?
Diversification, and still
How
diversification.
Does that look like?
So we also add something on the alternative investment side. We have seen this year already, once again, another stellar year for gold, but it's not just about gold. You see also industrial metals, which are on the up. You look at copper, silver, for instance, aluminum. And we see a lot of need for those industrial metals for the energy transition that is necessary for the AI theme. So there's more room to the upside and to really be prepared. If things a bit more choppy next year, markets turn a bit more sour, that you're not kind of under too much emotional stress also to take at the wrong time the wrong decision.
I'm not sure if you do look at cryptocurrencies, is what's happening with Bitcoin, breaching $90,000 a reflection of those concerns that you're talking about?
It is. We see a bit of here, especially the de-risking at markets currently, like the worries about valuation, geopolitical tensions, also now with Japan, China, the tensions there. So a lot comes together right now. And Bitcoin, at the same time, we see not so much liquidity, actually. So it's a bit more like, I would say, tech on speed, and now a bit more on the downside. Of course, we look at crypto, but for us, crypto is not part of a traditional portfolio because one way or another, it's just dominating the overall portfolio, right? If you just allocate 3-5% of Bitcoin to a portfolio, if it goes up 50%, all you see is Bitcoin. If it goes down 50%, or like now from October, 30%, all you see, if you look at your portfolio statement, it's Bitcoin. So we advise take it separately, also for kind of emotional protection.
Felix, great insights. Thank you for joining us. Felix Brill, CIO at VP Bank. We have some breaking news out of Apple. Apple iPhone sales surging in China, taking a 25% share. iPhone 17 sales drove a 37% rise in Apple's monthly smartphone sales in China in October. First time Apple's market share in China topped 25% since 2025. Taking a look where we are in terms of some of those stocks, Hanhai currently down. Of course, this is a down day pretty much across the Asian markets as we await numbers out of Nvidia. Well, plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back to Insight. AI-related assets are facing a reckoning as investors reassess risk and challenge valuations. We spoke to Kai-Fu Lee, chairman of Sinovation Ventures and CEO of 01.ai, about the business models forming around the technology. He makes a case for why the Chinese approach could be more sustainable than the one in the US.
The fundamental difference is actually closed source versus open source.
Yes.
The US model is necessarily propelled by this ambition and dream of one company reaching AGI first and squashing everyone, winner take all worth trillions of dollars. That's what OpenAI, Anthropic, Google, and others are betting on. And it's like a genius kid who thinks he or she will win the Nobel Prize. The China approach is, hey, let's all work together and share, we compete, but let's open source our models. So A learns from B learns from C. It's more like a study group of smart kids, maybe not genius kids.
But is the open source a reason why a lot of these Chinese AI startups cannot monetize?
Well, I think there's a common belief in US and China. AI is the most important technological revolution ever. There is a belief that this monetization will happen.
Okay.
It's happening first in the US, and it will happen later in China. So there is a bet that if all of China kind of pseudo collaborates through open source, then builds a great platform, then everyone can benefit because the knowledge of the platform. Or if one company comes out ahead, there's a chance to leap ahead and be the next great company as well. So there's tremendous optimism that AI is changing the world, and these models, closed source approach is a belief one company will squash everyone else. Open source is, hey, let's share for now and we'll see what happens.
In China's case, where you don't have to pay for it, where it's open source, how is the innovation getting funded, and how do you justify to those asset allocators that they will get a return for their investment?
Well, I actually like the Chinese model better. While the likes of Alibaba, ByteDance, Baidu, they're paying a lot of money. They're willing to subsidize because it's fundamental to their core business, whether it's e-commerce or search or social. And I think they're smart business people. They'll do the balancing. They're not spending a tiny fraction for the OpenAI spending.
Right.
Now, the OpenAI spending is a big bet, big return. It's betting that it will win. Whereas I think Alibaba, Baidu, Tencent, ByteDance, if they're spending more prudently, which they are, they will be able to look at the whole balance sheet and deliver a reasonable result. We don't see any of these people reporting huge losses.
Right.
So I think the Chinese model is more prudent for a financial investor. The U.S. is a winner take all. So you pick your winner. If you win big.
Yeah.
If you lose big.
That was Sinovation Ventures Chairman Kai-Fu Lee speaking to us on the China Show. Now, staying with Chinese AI, Baidu is set to report its third quarter results today, and investors will be focused on the strength of its AI cloud revenue growth. Bloomberg Intelligence senior analyst Robert Lee joins us now. Rob, what has been driving the stock? It's been a pretty wild ride.
Yes, a wild ride and a half, Haslinda. Well, I think, as you mentioned in your preview, people will very much be focused on the cloud business. We expect the momentum of that to pick up further, driven by increasing development spend in China's AI sector. But taking a step back, the level of revenue relative to their core search engine business is actually quite small. In fact, too small to really move the needle at the bottom line. And I think the bigger concern with a stock like Baidu or a company like Baidu is its core search engine business. So people have often referred to Baidu, for those who are less familiar with it, as the Google of China. So they were the dominant search engine business and remain so to some degree. But search engine revenue generation is ultimately driven by advertising spend. And obviously, China's advertisers are going to spend their dollars where consumer eyeballs are going. Increasingly, people are using or using Baidu to a lesser extent as platforms like Douyin, which is China's TikTok, and also the likes of Xiaohongshu rise in popularity. So as a result, Baidu's been really bleeding advertising dollars. And if you look at the consensus numbers going into the Q3 print today, the consensus is actually looking for the net income in that business to halve, to be down by 50%, which is a massive decline, reflecting the lack of real monetization on the AI side and the huge pressure that their core search engine business is under.
And Rob, speaking of bleeding, just to let our viewers know, the Nikkei 225 is bleeding. It is down about 3% as we speak, and this has to do with that risk sentiment pretty much across Asia. We know you've been bearish on this company all along, right, Rob? I mean, it's no secret. Has your fundamental view changed?
No, well, I think, every investor that, requisite number one is keeping an open mind to things, but I think our view on the fundamentals for Baidu has been on the money so far. You've seen a liquidity-driven rally, a lot of local buying in the China market over the last 6 months or so, which again, going back to what you said at the beginning, it's been a wild ride for Baidu's stock price, but ultimately it's the fundamentals that drive stock prices over the medium term. So I think, today's results will be a back to reality, back to basics. And unfortunately, for Baidu's perspective, this is a business which is actually under massive pressure at the moment. I would also argue it's too thinly spread because they're pursuing potential leadership in the robotaxi space and autonomous vehicle space, as well as AI, as well as chatbots. They're a medium-sized business. And I think the last thing I'd mention is, if we had this conversation 2 years ago, Baidu was clearly the leader in China's AI software sector, but their lead has been progressively reduced as the big guys, the big tech platforms, the Tencents and Alibabas have moved into that space. So it's a business, unfortunately, that is thinly stretched and under huge pressure and just doesn't have the resources, whether financial resources or engineering resources, to compete with these big players coming in. Unfortunately, no wonder they're under massive pressure.
Rob, thank you. Bloomberg Intelligence senior analyst Robert Lee there. And it's not just Baidu. Xiaomi also set to report earnings. We'll have more on what to expect from the company that makes mobile phones, cars, and almost everything in between. Meantime, well, it is a painful day if you're in the markets. We're seeing Asia extending the losses that sell-off in global stocks carrying on to its fourth day as investors turn cautious ahead of Nvidia's earnings, as well as the key U.S. jobs reports later. Of course, we had the Nikkei 225 under pressure. It continues to be under pressure, down by 3.2% as we speak. The Kospi also down. It is lower by 3.3%. So a red day pretty much across Asia as we await Nvidia's report and, of course, the jobs data out of the U.S. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. We're seeing the global sell-off extending into Asia. In fact, the MSCI Asia-Pac Index hitting a one-month low, on track for a third day of losses. We have the MSCI Asia-Pac Index down more than 2%. The Nikkei 225 as well as the Kospi down by more than 3% as we speak. The MXAP below its 50-day moving average for the first time since April. Couple of things here. As we've been talking about, the numbers out of Nvidia is front and center along with that U.S. jobs report later this week. Yes, the jobs report is a tad late, but it could be an indication of what's to come in terms of the Fed move in December. In terms of the U.S. futures market, extending losses as well. NASDAQ 100 contracts down as we speak. The Euro Stoxx futures also in negative territory, down about 1.5%. In terms of the S&P futures, down 0.6%. It is red pretty much across the board. Alarm bells ringing for analysts to study chart patterns in the U.S. stock market, by the way, fueling concern that the latest dip could swell and we could just see a full-blown correction on the back of that. One stock we're also watching is Xiaomi, currently down about 3%. It's gone from market darling to the worst-performing Chinese technology stock in just a few months as it faces headwinds in the smartphone and EV markets. Asia Transport reporter Danny Lee is with us. Danny, one of China's hot emerging EVs is made by Xiaomi, better known as a smartphone maker. What will its earnings likely deliver? What are you watching out for?
Yeah, smartphones is really the bread and butter for someone like Xiaomi, but its push under Lei Jun, its founder, to really expand into something of a growth sector like EVs means it has paid off largely. The growth from EVs means it makes up around 20% of total revenue. It's still a very much growth driver, and it'll be fascinating to see what management has to say about that during third quarter earnings later on today. But for the market, the street, they're expecting revenue to come in around 113 billion yuan, so that's around 15.8 billion US dollars. That any kind of growth on the revenue side north of 20% year on year would be very much a beat for the street. And then when you look on the net income side, we're looking for around 9.6 billion yuan. So anything that sees the management talk not just about EVs, but of course AI would be very much closely watched. But it's the traditional kinds of business lines such as smartphones, Internet of Things, which will see fairly muted kind of revenue growth. But it's where you have the likes of EVs and AI, that kind of other new business initiatives that could see a combined revenue growth of up to 200%. So there's a lot to look out for and potentially digest. It's definitely not been smooth sailing for Xiaomi of late, but very much something we'll be very much looking forward to.
And the thing is, we've heard from other Chinese automakers as well, right? Out with earnings, namely XPeng, whose shares are being hammered. What's going on there?
Yeah, Xiaopeng shares are down by around 10%, the most in more than 7 months, because of a guide for the fourth quarter revenue that was lower than what the street had been looking for. So it gave a guide of around 21.5 billion yuan to 23 billion, but that's short of the 25 billion yuan that analysts had really been expecting. So it's disappointing on that front, despite the very strong run it has seen over the last several quarters now. But on the flip side, it's on the losses it's making. They're shrinking, and that kind of gives some encouragement that this is an EV company that could start to turn profitable in 2026, according to some of the analysts' estimates. So whilst it's still a bit of a tough slog, and particularly around the regulatory scrutiny that the wider China EV industry is facing, that doesn't just impact Xiaopeng, but the likes of Xiaomi as well, there is still some potential green shoots for the likes of Xiaopeng into next year as it pushes through to try and turn profitable.
Great stuff, Danny. Thank you so much for that. Bloomberg Asia transport reporter Danny Lee. Now, Brazil's President Lula da Silva is calling for a roadmap to transition away from fossil fuels. The country is hosting the COP30 summit, and the pressure is on for officials to reach a deal by Friday. Meanwhile, India's environment minister is calling on richer nations to step up. Speaking at the COP30 summit, he urged developed economies to move faster towards zero emissions and mobilize more funding to help developing countries meet their climate goals. Let's get perspective. Vaishali Nigam Sinha, co-founder and sustainability chairperson at Indian solar and wind power generator Renew. Vaishali, give us a sense of how optimistic you are about that roadmap that Lula is looking for.
Yeah, hi, Haslinda. It's really a pleasure to be on this show and to have a chat on what's happening at COP. I want to say that I am optimistic about what's going on at the COP in Brazil. There was an initial sort of tonality around who's going to get there and so on and so forth. But what I hear, there has been a lot of momentum around discussions, participation by the indigenous communities. I think the largest ever catering fair organized by the UN. A voice for the indigenous group on the table is being sought. So, these are all very important elements to ensure that, the folks and the stakeholders who are getting impacted by climate, because of which a lot of these discussions are happening, are there around and their voices being heard because they know what they're talking about. I think if we look back also, Haslinda, in 2015 at the Paris COP, there was a certain ambition where we had to meet our, temperature, bend the temperature curve. At that time, we saw it at 4 degrees. The target was 1.5 degrees by 2030. We have not got there, but we are at around 2.6 degrees centigrade. So not a stellar performance, but I must say that net countries are committed and are moving in the right direction. And if I could speak about, commitment here in India, all I can say is the intent is strong and the action is stronger.
You've talked about how COP30 is crucial for emerging markets in particular. For a country like India, how important is it, and what are you hoping for?
Sure. So, yes, absolutely, it's crucial. If you look at India, when we look at our trajectory from let's look at a decade as a benchmark. I think a lot has been accomplished. First of all, we've been able to accelerate and, sharpen our ambitions from about 75 gigawatts to, now we're talking about 500 gigawatts of installed capacity by 2030. Now, that's a huge leap in ambition. And what that does is that really propels all other stakeholders to get engaged and contribute to the emission reduction which the country has pledged for. So as we speak, if I could talk about even at the private sector, there's been a huge amount of engagement, whether it is in the traditional IPP sector, whether it is around just the entire value chain of manufacturing of solar panels and self-reliance. We've seen a huge amount of progress on the ground in terms of just an industrial build around greening our infrastructure, and also a lot of capital coming in because there has been a very active management of delivery of projects, policy trajectory which has been positive, and hence capital flows where there is efficiency of project execution. So net we see that we continue to do what we are doing. We are one of the fastest growing renewable energy sectors in a country, right, and look forward to accelerating that.
It is about getting the right partners, right? Partnerships as well as investments for India to meet the goals. Is India in a good place for that to happen?
Yes, absolutely, Haslinda. If I look at, if I could look at our own example, as far as fundraise is concerned, we've been able to actually mobilize equity investors over the last decade and a half from around the world. We've had JERA from Japan, and we've had CPPIB from Canada, ADIA from the Middle East, multilateral organizations such as IFC, all get mobilized to invest in India's renewable energy story. As far as our projects are concerned, we are seeing investments coming in from Asia, from entities like Mitsui and many others to invest in our project portfolio. We've just seen a very recent investment by BII, which is the British investment agency, in our manufacturing facility, which is one of the largest in India. So definitely we cannot do this without partnerships, not only with financial investors, but also partnership with our communities, partnership with other private sector players. And honestly, if I could also come to the point that it is important for us to really reflect on the global partnerships and collaboration and cooperation, which was really the beacon about 3 to 4 years ago, which is blinking a little bit now. But then others are stepping up. I see the step up happening in India.
How are you planning to scale your generation portfolio over the next 5 to 10 years? What needs to happen? What's the vision? What is the strategy?
Sure. So, there's a huge amount of opportunity in India. I mean, when you go from 75 gigawatts 10 years ago to 500 gigawatts target, there has to be action on the ground. And over the last, I would say, a decade, we have seen FDI inflows increased by 140+% in a decade, and just 18% in just last year by 18%. So there's a huge amount of funds which are coming in to feed into just conventional renewable energy growth, which would be solar farms, wind farms, etc. There's hybrid sort of facilities we are setting up. The first and the largest ever round-the-clock facility which we've set up, where we have a global partnership as well by global companies. So also green hydrogen, of course, has had its own hiccups, but we really do need, that's growing well. The policy framework is in place. I think we need a little bit of step up by the developing economies from the demand side, but on the supply side, there is a huge amount of infrastructure which is being set up, and I'm pretty confident with cost of electrolyzers, etc., coming down. I think we will be able to see a kick there as well. As far as manufacturing is concerned, it's a huge opportunity. And I must credit again the Indian government's PLI, which is a product-linked investment framework, which has really driven the private sector to get engaged and to set up facility on the ground, which is globally competitive and is generating jobs. So, there is a domestic push and there is a demand in India and globally as well for the panels which are being manufactured and the entire product chain as well.
There is currently a lot of talk about green hydrogen and the carbon market. How important are these to your future growth at Renew?
So I would say that the portfolio, as I highlighted, it's about the traditional renewable energy, which is currently about 60% of our portfolio. Our manufacturing facility is growing quite well, and products like pumped hydro, green hydrogen, and are all a part of our portfolio. But we are also waiting and watching to see what's going on there, because there are lots of, as I say, pieces of puzzles globally also which need to be resolved. So perhaps more collaboration globally to be able to kick these off here, and some technology and innovation to solve for product innovation and cost associated with it. Right now, green hydrogen costs about $3 to $6 per kg in India, and compared to about $2 for grey hydrogen. We are hoping that we can bring it down. We've seen it for the traditional IPP sector, and we are quite hopeful with consistent effort, with the supply and demand balancing out and some enabling policies globally, not only in India, we'll be able to get there.
But in terms of green hydrogen and emerging markets, realistically, how big a role can it play in markets like India?
No, absolutely. I think green hydrogen, there's a huge hard-to-abate sector in India. And there is, of course, a huge demand for sectors like steel, cement, etc., as they sell their products globally, for them to sell green products. And green hydrogen really is going to be a part of the puzzle, which is going to solve for this product competitiveness. So as far as we are concerned, we provide the clean element to it, moving it from, I would say, grey to green. And we see that as an opportunity. But as I said, every opportunity takes time. So we need a little bit of sort of innovation and cost effectiveness for the product. And I think the industry is coming together to address issues and gaps. And the government has also helped in enabling policies as far as green hydrogen is concerned. So it is a part of our portfolio, and we are deeply committed to growing our portfolio here in India.
You touched on innovation a lot. I'm just wondering, what is the case for future tech in the decarbonization roadmap for countries like India and other emerging markets?
Sure, that's a great question. As far as, we've been hearing a lot about data centers, and data centers are being set up in India with great amount of speed. And a lot of these data centers need decarbonization solutions. And at Renew, we are working with a lot of these partners, including Microsoft and various other companies, are in discussion with other companies to provide them with the clean energy which is required. So that's really going to be the future, and we see that as a huge opportunity in our portfolio as well.
In terms of China, China's dominance in the industry, how do you assess that, especially in relation to India?
Haslinda, I think, China is, doing what it's doing, and it's, and that's, they have their own strategy. I think what India has been able to do, given the current geopolitical complications we see around, also the need for us to be self-reliant. I think India, because of its policies of self-reliance, has been, over the past 5 years, triggered by COVID, been able to build our entire value chain in India in a way which is, which is competitive and which helps us to be self-reliant. And so we are working on our quality and our production and manufacturing to ensure that we can really not only use products made in India, but also make them competitive globally. And we are seeing a huge amount of demand for our products globally as well. We've seen that in certain parts of the world, the commitment to renewables is going down, and it's a real opportunity for India to step up. I think there's so much demand globally for renewable energy, for clean tech, that India, there is enough space for multiple countries to really double up their efforts, and we see that happening in India quite well.
When do you see perhaps, Indian companies like Renew being as competitive as their Chinese rivals?
Sorry, what was that?
When do you see companies like Renew being as competitive perhaps as their Chinese rivals?
I would say that, comparison is good, but I believe that, it's good to be focused on our own strategy, meeting our goals. The 500 gigawatt goals, our self-reliance on products which are being made here, and focus on innovation, quality, and technology. As you know, India is the capital. So it's not about being competitive with China. It's really about, building our own products in a way which is the best offering for other, the demand coming globally. So I think that is our focus, really to focus on our own journey, which is pretty tremendous. And, we are one of the fastest growing economies. We are the fourth largest as far as the renewable energy sector is concerned. And these are pretty good metrics to be competitive globally. So I would say that we are on a track to be competitive globally. And we've come a long way over the last decade. And as far as some of our deliverables on the ground are concerned, they are very ambitious. And we have actually also achieved some of our goals, our 2030 goals, ahead of the target as use of electricity from non-fossil sources. Our target was 2030.
Vaishali.
We've achieved it by 2025.
We have to leave it there. Vaishali, thank you so much for joining us. Vaishali Nigam Sinha, co-founder and chairperson, sustainability at Renew. Plenty more ahead. This is Bloomberg. Amazon has raised $15 billion in its first U.S. dollar bond offering in 3 years. The move adds to a spree of jumbo debt sales by tech firms as they race to fund AI infrastructure. Let's get more with our Asia Tech correspondent Annabelle Drew-Lisbell. The proceeds topped estimates. What will they be used for?
Yeah, you're right. I mean, the initial goal was $12 billion, so we exceeded that to the tune of $3 billion. And actually at the peak, as what we've heard from sources, demand was around $80 billion before orders were then cut in half because borrowing costs were starting to fall. But yes, you asked what exactly these funds are going to be used for. And in short, it's basically everything. We're talking about CapEx, we're talking about share buybacks, we're talking about acquisitions, really trying to fund this build out and this race in AI. But as you said, it's been quite a period where we've had a lot of companies that have been looking to not only boost here. You can see Amazon's investments into general CapEx, but a lot of that going into AI, scaling up the cloud part of the business, AWS, of course. But generally, we've seen big tech really racing to issue debt in the market. So, for instance, Alphabet earlier this month issuing $25 billion. We had Meta, you can see there, $30 billion. Oracle as well, $18 billion, in part to meet their commitments they've made, again, around this AI infrastructure race in the US. But back to this specific sale and what it looked like. So what we've heard from sources, it was sold in 6 tranches, pricing on the longer portion of the deal. So you're talking about the 40-year note here. Actually, the spread on that tightened to 0.85 percentage points above Treasuries. It was actually earlier 1.15 percentage point initially. But again, according to sources, Goldman Sachs, JP Morgan and also Morgan Stanley, these were the banks that managed the bond sale as well.
And Jeff Bezos joining an AI startup. What's the story there?
Yeah, this is an interesting one. So this is actually reporting that came through from the New York Times, but Jeff Bezos rather has joined what they're reporting is Project Prometheus. So Project Prometheus, this is an AI startup. He's going to be joining as co-CEO. Again, this is from their reporting, but it is a company that's going to be coming out of the gates reportedly with $6.2 billion in financing. Now, $6.2 billion in financing. What the New York Times says at this point, it's got around or less than 100 employees, so it would make it one of the most well-capitalized AI startups in the world. This is actually the first time we've seen Jeff Bezos as well taking a leadership position since he stepped away as a CEO of Amazon back in July 2021. So it is very much an interesting move. And I think as well, just the name, that Project Prometheus, I did do a bit of a refresher on my Greek mythology, but Prometheus, the deity known for his intelligence, his defiance of Zeus, and his role as a champion of humanity. So again, just on that intelligence piece, I mean, they've clearly got big expectations for this company that's going to be doing AI around, or that'll be used for the engineering and manufacturing of computers, automobiles, and spacecraft.
Well, great stuff. Thank you so much for that, Bloomberg's Annabelle Jewelers. We're keeping a close watch on cryptocurrencies. Bitcoin going from bad to worse, under a lot of pressure, as is the rest of the markets today here in Asia, extending the losses that we saw globally. Bitcoin breaching that 90,000 level, 89,625 is the level we're looking at, down about 2.5%, erasing its gains for the year, dragging the broader risk complex with it. And Bitcoin down about, 16, 17% this month alone. 2% on the year. Once the best performing major asset class of 2025, but no longer, not today anyways. Before we go, here's a look at our guests for tomorrow. We'll be live at the Bloomberg New Economy Forum here in the Lion City. Nubank, London Stock Exchange, Hyundai will be joining us. This is Bloomberg.